Alright guys, first of all, I need to say something before we start. I know I've been gone for a while. The channel has been quiet, and a lot of you have been asking what's going on. So yeah, sorry for the long absence. Sometimes you need to step back, watch the market, and wait for the right moment to come back with something meaningful. And right now, that moment is here. Because if you look at the market honestly, without the hopium, without the moon boy thumbnails and the Bitcoin to a million tomorrow narratives, one thing becomes pretty clear. The bear market is in full swing. The momentum has shifted, the structure is weakening, and the panic you're starting to see in retail, that's usually how these phases begin to accelerate. Retail right now is confused. First they were told the bull run would last forever. Then they were told every dip is a buying opportunity. And now they're staring at their portfolio wondering, wait, why is everything still going down? Because markets move in cycles. They always have. And when liquidity dries up and sentiment flips, the market doesn't just gently drift lower, it breaks people. From what I'm seeing in the charts, the pressure is building. The structure around the higher levels is weakening, and the market is slowly pushing toward a point where things could move fast. My view right now is pretty simple. We're heading toward a break below 60k, and when that level goes, things could get messy. Because that's where a lot of leverage sits. That's where a lot of people told themselves, this level will hold. And when those assumptions break, that's when you get the real moves. Now don't get me wrong, bear markets aren't just pain. For people who understand the game, bear markets are where the real opportunities start forming. But first, the market usually needs to do what it always does. Shake out the weak hands, break the narratives, and remind everyone that crypto is not a straight line to the moon. So buckle up. The situation is tightening, retail is starting to feel the pressure, and the next moves in this market could get very interesting. And this time, we're going to watch it unfold together. Alright, let's dig a little deeper into the structure here, because the chart is actually telling a very interesting story. First, let's go back to the moment when the market dumped from around 80k down to 60k. That was a brutal move, and in that move we created a very important inside weak value area. Now why is that important? Because these value areas tend to act like magnets for price later on. Markets love revisiting zones where a lot of trading activity happened. So in the second chart, we zoom into that dump area a bit more. And what do we see? Price came back into that exact value range and reacted almost perfectly. First, it tapped the VAL, the value area low. From there, we bounced and moved all the way back up into the VAH, the value area high. So essentially, the market did a full value rotation inside that previous range. And if you understand option market theory, that's exactly how markets behave. They rotate between areas of value before deciding on the next direction. Now let's move to the third chart, which shows the current value area of the range we're trading in right now. And here things start to get interesting again. Because if you look closely, we're sitting right in the middle of another potential value rotation setup. We already tested the upper parts of this range earlier, got rejected, and now price is slowly drifting back down toward the value area low again. And this is the key point. If we break the VAL of this current value area, the structure shifts. That would mean the market is accepting lower prices again, and that usually leads to the next leg down. And where does that bring us? Right back toward the 60k area. In my view, that's where this is heading. A break of VAL, acceptance below value, and then the market makes its move to finally take out the 60k lows. And if that level goes, that's when things could get really interesting, because that's where a lot of liquidity is sitting. So for now, the market is still rotating, but the pressure is building. Alright, and finally let's take a look at the bigger structure here on the daily chart. What you can clearly see is a repeating pattern. Price forms a range, then we get a small deviation to the upside, everyone gets excited again, the moon boys come back on Twitter, and then what happens? Price rolls over and breaks lower. And this pattern keeps repeating itself over and over again. Every time the market pushes a little higher above the range, retail starts believing the bottom is in. They buy the breakout, they start talking about the next bull run, and that's exactly when smart money distributes into that strength. Liquidity moves from retail to smart money. You can literally see it happening on the chart. Range, deviation, distribution, breakdown. Range, deviation, distribution, breakdown. And because we're in a bear market environment, the probabilities are stacked toward continuation. That means the market is more likely to keep forming lower highs rather than suddenly reversing into a massive bull trend. So until that structure changes, the path of least resistance remains to the downside. And if the levels we talked about earlier give way, the next logical target is the liquidity sitting below 60K. That's where the market will want to go. Alright guys, that's it for today. Again, sorry for being away for a while, but I'm back now and we'll be watching this market closely together. In the next videos, I'll start sharing more of the deeper insights behind my trading framework. And I'll also show you ways how you can actually benefit from this knowledge instead of being the liquidity for someone else. So if you want to stay ahead of the crowd, make sure you subscribe to the channel because the next releases will go much deeper. I'll see you in the next one.